Mm-hmm.
You know what I'm saying? You never got to meet. I went to take the exam today, didn't give me the exam. 2 for 1. No, I was like, he was right there, everybody started, and I was like, can I get one?
So, I have a potential scheduling conflict. If you guys are adamant about having a class next Thursday, I will supply you with a class next Thursday. But I propose an alternative. If you guys are willing to lend me an extra 40 minutes next Tuesday, I will cancel class next Thursday. So time-wise, you either win or get cheated out of, is it 40 minutes? No, 30 minutes, depending on which side you're on. But if there's a scheduling conflict, then we're gonna have to do class next Thursday. So that's the starting point. Can anybody absolutely not do class next Tuesday, 40 minutes late? So we do a 2-hour class instead of a hour and 20-minute class. Scheduling conflict?
Well, I guess you would need it.
Oh, you guys are on softball league or something? Okay.
I don't know that.
Well, I'll, on Thursday, I mean, you guys are invited if you want. There's a presentation going on. The finance department is putting on about energy markets.
I will after class, but just stay after.
Fair enough, thought I'd offer.
And probably start a Google.
So I hear of potential scheduling conflicts.
I'll do it and I can miss
Okay. So, okay. Let me know if the scheduling conflicts get unbearable, then let me know. But is everybody else okay with having an extended class 1 week from today and missing a class, the class after?
Sure, could you record it? Could you do your own little session here without us and just put it up on the YouTube for us to watch?
You already have your own channel.
What's that? You said I have my own channel. Can you tell me what my channel is?
It's on my YouTube videos, so it's, I could probably compact it all into one.
My family's like asking to see how I teach, and I say horribly, but they don't believe me.
I can send you this after we're done with it, and then you'll see all these videos.
What's the name?
Their email address, we'll let
It's
them
like the
know.
name of the.
Yeah, I appreciate that, Sam. I don't-
FIN, or mine's
Okay,
Crystal
okay.
Long.
So am I hearing
It's
that
under my-
you will not be able to make it?
No, I'm just saying so that we don't stay, if anybody doesn't want to stay for 40 minutes extra. You, like I said, you can film yourself here or anywhere, 40 minutes, and then just send it to us.
So it's like, Crystal, you can stay and film when
Yeah,
we're all
I've just never
leaving.
done that before, so I hesitate to
Say yes.
go for
Or
it. But
we would be responsible to watch it.
Here you go, bud.
okay.
I don't know, this, that's what I'm saying.
That's I appreciate the suggestion. I'll have to think about that.
She's gonna create
Um,
those things.
I guess I'd have to try it out because basically I've watched a lot of instructional videos on YouTube and I know a lot of them are crap because the camera's in the wrong angle or you can't hear what they're saying, so I'd probably have to do a few practice.
Yeah, those are probably my videos, you
Yeah.
know, the crap ones.
No, just because OpenCourseWare is that as far as.
Yeah, no, OpenCourse is great, but even on some OpenCoursewares, like some, you're at the very back of the lecture class and you can't hear. But I don't know, that's just my experience. But I'll think about that suggestion.
I'm fine staying, that makes sense.
Okay,
Yeah.
so just so I know, is anybody adamantly opposed to staying 40 minutes later?
No, I have a question. Okay, so when do we get our homework back?
You get your homework 5. That is another topic on my agenda. There's going to be a little shifting around the last part of the semester. So I am currently running 1 class behind. We are extending mortgage to 3 classes as I had originally planned instead of 2 classes as I had to condense. And there's a reasonable chance that we'll have to do that with exchange rates as well, or foreign exchange. So there is a possibility that the last 2 classes that are listed on your syllabus, that'll just be spent on foreign exchange. So basically, as I propose it, today I'll finish up mortgages. Thursday I'll start foreign exchange. Tuesday,
You'll hand out homework.
what's that?
You'll hand out homework.
We'll get to the homework in a second. Tuesday, I will finish foreign exchange, and we have an extra long class, so I'll be able to probably introduce some market crisis stuff. I will hand out homework on Tuesday. That way, it will be due May 3rd. So you guys will have good 2 weeks, but that way that'll allow me to cover mortgages and exchange rates, and I can give you homework on both of those, so you have practice with both types of problems.
And then our finals that Thursday, May 5th.
Yes, your final is that Thursday, May 5th.
Okay, and are we doing an extra review?
We are doing 1 day of review, that would be May 3rd. If we need extra review, I would be happy to offer an extra non-school day review, another McNelly session or something like that.
Okay.
But I guess I will ask what days, what times work for you guys
I have
better. instead of
class
just
on
saying
Thursdays.
Wednesday, 'cause
I can't
maybe
ever go
that's
to
the
that
reason
because
some
I have
people-
class.
Jay,
And just while we're on schedule,
Sure.
so what days are the presentations on?
so this week is finishing up mortgage and foreign exchange. Next week, I'm finishing up foreign exchange. The following week is the presentations, are the presentations.
Okay.
So it should be the last week of April.
Okay.
Tuesday, Thursday are both food arrangements?
Yes, correct.
Who's going first? I know you said two groups, it would make sense for them to go second, right? So it'd be mortgage and,
So
so we'd be good.
I don't want to commit to anything yet, but
Is it gonna be surprised?
So
like
Tuesday,
last time?
I think
Thursday?
it should be surprised.
Mhm.
'Cause that-
April 26th and 28th?
If those are the
My luck, I'm
dates-
first again.
What's that?
Said my luck, I'll be first again, so I might as well just plan
Thought
for
you
it.
guys volunteered to be first. Or someone
No,
volunteered you.
no. He volunteered to be first. Remember, he wasn't in my group.
Oh, well, you said with my luck. I'll be
You
first again.
volunteered us to be first.
But I thought he volunteered.
He's not. He wasn't in my group.
So you didn't go first?
That first setting, yes, that first period. Yeah.
Gotcha, okay.
Not.
Could be,
Yeah.
sorry. Okay, I think we have clarified the administrative matters, unless you guys have anything else?
This is going on the YouTube channel, right?
No class Thursday, if you guys agree.
Next week.
No class next Thursday, if you guys agree to show up next Tuesday and stay for an extra 40 minutes. Yes, yes. Okay. I've managed to confuse people. Okay.
Wait, when is the, wait, so next Thursday?
No class the 21st.
Okay.
Yes, no class the 21st. Yes, this is why they created it. I can just say that. No class the 21st, presentations the following 2 class periods afterwards.
And those
No
dates
other
are.
adjustments. Sam told me those dates. Yeah, I trust you can read a calendar.
The 26th and 28th.
Clear as mud.
No class the 21st.
What do you guys think is
I can't
reservation
look
space
at my
for
calendar.
26th and 28th.
Are the presentations.
Fantastic.
28th is when
Feel better now.
Me too, I guess.
Some Thursdays.
Okay, I trust you guys can figure out how calendars work. If you have any other questions, email me. It's a waste of all of our time. Okay. So, we are going to finish up mortgages today, whether you like it or not. So, I'll start with a few other considerations when someone is getting a loan. And these might be review from when we talked about 5 Cs, but they're worth going after. They're going over.
We have no class.
So, a loan is just the exchange of some money for the promise to pay some other money back at a specified date or over a period of specified dates, okay? There are all sorts of features we can put on that loan to try to increase the cost of borrowing, decrease the cost of borrowing, all sorts of that. In the context of bonds, we talked about put options or embedded options such as put, call, convertibility, talked about sinking fund provisions. In the case of mortgages, there's sort of a different subset of bells and whistles that we could put on loans, okay? So one of the most important subsets, one of the most important additions to just a standard promise to pay money back is called collateral. And this should be reviewed by now. This is basically an asset. So the person you promised to pay back has control of one of your assets before you have fully paid him back. And the way this works is that the lending institution, financial institution, yes, this is still mortgages. goes out and puts a lien on your property. Does anybody happen to know what a lien is? Spelled this way, not lien on board. What's a lien?
They can take it over if you want.
It's basically a document that you file with.
Like they can't sell that property or anything that has a lien on it until they pay the lien.
Yes, yes. So. So it's a document filed with the state registry that says that, in this case, a bank, but there could also be other kind of liens, has the bank basically has ownership of the property legally until the loan is paid off, okay? So they put a lien on a piece of collateral. And as Crystal mentioned, if you want to sell the piece of property, you cannot do it while there is a lien on place. That's why lawyers, any good lawyer, must search registry for liens on titles before processing sale of assets. Now, are they going to search for a lien on a wheelbarrow in the case of a farm? Probably not. But if we're talking about substantial assets like houses, commercial property, even some vehicles, then they should check the registry to look for liens on the asset. And if there is a lien, then it is illegal to, transact that asset, because you're basically taking it from the bank. You have no right to do that because it's not yours. So, those are liens. Another thing we must consider, and so what do you guys think happens to the cost of borrowing if you offer the bank some collateral? Goes down. And the more collateral you offer the bank, the more of your property you relinquish ownership to the bank, the more your cost of borrowing goes down, or the less your cost of borrowing is. Okay? Pretty intuitive enough, because the bank has less risk in that transaction. Even if you default, they can sell your property, make money. So, another thing we have. Say yourself.
Yeah, what was that last sentence? Lawyers what?
Lawyers must check the registry for liens on titles before they transact.
Thank you.
Sure. Okay. Another thing we have to think about is a down payment. So, a down payment represents the fraction of the asset's value that the purchaser is investing his personal equity into. So I'll write that down. This is chapter 14.
Okay, thanks.
So typically, down payments on various assets range between 5 to 8%. Okay? So if we're buying a house and it costs $200,000, we put a down payment of 20% on that house. That means we are putting in our own $40,000 that we've saved up, and the bank is supplying the residual $160,000. Okay? What do you think is going to happen to our cost of borrowing if we decide to put down 10% instead of 20%? Goes up. Why does it go up? Who said it goes up? Because it's going to take more time to pay off a loan? Yes, that's another good reason. So the bank has to incur more sort of time value of money kind of issues, more opportunity cost of using that money. That makes sense. But it's also primarily due to moral hazard concerns. And this is something we alluded to several times, but housing prices fluctuate, all right? So let's say you bought a house that was worth $200,000, okay? And you put in 10%. So that means of this entire value of the house, yours was 20K, okay? What happens when the value of the house the next day falls to $195,000? You can no longer sell it for $200,000. You can only sell it for $195,000 now. Well, you haven't even had time to make any sort of interest payment. It happened literally the next day. So your equity of $20,000 now became equity of $15,000. That means of this entire asset, you used to own $20,000 of the asset, $20,000 of this $200,000 asset. Now you own $15,000 of a $195,000 asset, right? So you now have 15K. If this keeps falling, let's say it falls to, the house is now worth $170,000, you no longer own any of that asset. You still owe the bank, no, I'm sorry. Yeah. You still owe the bank $180,000 because we put down $20,000 down payment. So you house is only worth $170,000. Why would a rational person pay $180,000 for something that's only worth $170,000? It's not like he has any invested money in the house anyway, because all of his collateral has been wiped out. All of his equity's been wiped out. So he's going to default on it. That's called a strategic default. It's strategic for him. It makes sense for him to default on that house. And so the lower your down payment is, the higher chance to the bank of being victim to strategic default. Does that make sense to everyone? I call this a moral hazard concern because after the bank gives you money, they can't control what you do with that money. So say you owe them $180,000, well, I'm just going to decide not to pay you back. Take my house. You know, that's a case of moral hazard because the incentives of the individual are not perfectly aligned with the incentives of the lender. So an individual may choose to do something that the lender doesn't want to do, ex post. Okay, are we good on down payments?
What if it increases, sir?
Pardon?
What if it increases the value of the house?
What if the value of the house increases? That means there's less risk for the bank. So that means your equity stake, let's say you put down $20,000 down payment and the house is now worth $210,000. That means you basically paid $20,000 for something that's now worth 30,000. Pretty good deal. But if it's volatile and fluctuates a lot, then, you know, the bank still has to worry. But in general, the bank's investment just got safer. Like, oh, he's definitely not walking away from this house. He'd be handing us $30,000 if you walked away from this house now. Does that make sense?
Is it the 20,000 plus the 10?
Yes, exactly. 20,000 plus the 10 is the 30,000. So if I decide to strategically default or unstrategically default, let's say, no, fine bank, I'm not paying you, you take the house, then they'll say, happily, we'll take the house, sell it for $210,000, and we only gave you a loan for 180, we'll keep the difference. Everyone wins, except for you. Okay? PMI, private mortgage insurance. So, banks typically require, we'll get to this in a second. In some circumstances, banks will require the borrower to go out to the insurance markets and find an insurance provider that will insure the bank against the difference between what the person owes the bank and what the bank can sell the house for. Okay? Here's how it works out. So, let's say we had that first scenario again. And let's say it's worth $170,000. So it started out $200,000. Equity prices plummeted. 180 was what we got the loan for. The next day, equity prices plummet to 70,000. So, I'm sorry, next day, house prices plummet to 170,000. So, the house started at 20,000, and the next day it's 170,000. Meanwhile, you still owe the bank 180,000. You guys with me so far? So, without PMI, the bank would have to incur a $10,000 loss. But what PMI does is it says that, look, bank, if you can only get rid of this house for some level that's less than what the loan is actually worth, then we will pay you the difference. So it mitigates the downside risk to the bank. You look untrustworthy. No, not untrustworthy, untrusting of me. No? Did my explanation make sense? Is it your food that's confusing you? Okay, so let me go through it again.
Okay.
So, PMI insures the bank against the possibility that they will have to incur a loss on their loan if the collateral value dips below the loan value. So, if the collateral value dips down here, a strategic buyer would say, here are the keys to the house, bank, I don't need it anymore. And the bank has to go out in the market and says, who wants the keys to this house? And Xiaoling says, I'll take the keys to the house, but I'll only pay you $170,000 for it. And the bank says, crap, I have this asset on the books for $180,000. I can only get rid of it for $170,000. That means I have to take a hit to earnings of $10,000. But don't worry, bank, because this loan has PMI on it. And that means that the bank takes $170,000 from Xiaoling in his bank, and they go to Crystal, who's the head of the PMI department in the insurance company, and Crystal writes us a check for $10,000. And so the bank is made whole. Now, combining these two sources, the bank has exactly what it was worth, and it hasn't lost anything. Did that make sense?
So who pays her $10,000?
Nobody pays her $10,000, but she will make premiums off the fees. Because if Ruben brought this house from me in the first place, and I said, Ruben, I won't sell you this house, or I won't give you a loan for this house, unless you go and get PMI on it, then Ruben has to buy PMI from Crystal for some fee. I don't know what varies.
Well, no, I think since I got mine federally, whatever, they had to approve everything, and they require you to have PMI until you pay it down to 75%.
Do you have FHA loan or yes? Okay. So we'll talk about that in the coming moments here. but.
They require PMI.
Yeah. Okay, yes, so we'll talk about homes that require PMI. Okay, so we're good on PMI. Now let's talk about borrower qualifications. These are important. So there are some ratios that it's important for bankers to consider that have to do with the borrower, okay? So there is okay. This considers the total amount of interest that this borrower is making on all of his debt relative to how much he takes in every year. So what they'll do is they'll take your federal tax return, they'll figure out how much money you made last year, they'll go to FICO and get your credit history, they'll figure out how many other loans you have, how much credit card debt you have, they will estimate your total your total interest payments that you have to make every year, and then they will say, okay, if we gave him a loan, that means he'd have to make an additional $833,000 payments, let's say. And so they will take dollar amount interest payments. And here interest means, let's call it dollar amount debt payments divided by income. That gives you your debt to income, okay? And lenders don't want this ratio to be over 33%. They don't want to give you that loan that puts you over 33% because there's a structural break in your ability to repay debt if you have more than 33% of your income as debt payments, okay? There is a related concept here called payment to income. And this basically says, let's say you have no credit card debt or any other debt outstanding. We still don't want to give you a loan that would represent more than 25% of your income. Okay, so they don't want to give you anything that would be over 25% of your income because it's really hard, it's much harder for a borrower to repay a loan and happens much less frequently if that debt payment on that loan is more than 25% of his income. Okay. We have FICO scores, Fair Isaac Credit Organization. We don't need to know the acronym. And anything above 720 considered good. Anything below 720 but above 660 is considered fair. And anything less than 660 bad. And it might be a good idea for some of you guys to check your credit, preferably before you go and apply for a loan. Because this will let you know, A, if your credit information's been hacked and someone's been messing with you, and B, if you'll be able to get the loan that you want way before you need it. And you're entitled to one free credit report a year. There's plenty of organizations that will put it out. In addition, a lot of different credit cards that you can get give you free FICO scores.
Those both say 660 on fair and bad.
Yes, I didn't know how to put it would be less than 660, so. This is greater than 660, but less than 720, and so that's fair. And the last thing, and arguably the most important thing, is your loan to value. LTV. And lenders want to see a loan to value greater than 80%. Some lenders will do 75%. This, again, is the flip side of your down payment. The more you put down in your down payment, the lower your loan to value will be. So the value of the house in that example was $200,000, let's say, at the beginning, and the person got a loan for $180,000, his loan to value would be 90%. If the loan to value happens to be above 80%, then almost all borrowers would require you to get PMI. And that's the case with a lot of FHA loans and VA loans, is they get lower loan to values because the VA and the FHA both guarantee these loans, so it's less risk. But to compensate the FHA and the VA, those agencies require you to get PMI. So basically, loan to value is probably the single most important indicator of whether or not you're going to keep paying your loan or defaulting, because in that example, when the housing price dropped to 170, your loan to value is actually above 1. So you won't pay on a mortgage where your loan to value is above 1. So this is important. Okay, done here. All right, a few different classifications that I'll just bring up now so that I can continue speaking about these things. We have insured versus conventional mortgages. And we have fixed versus okay. Insured versus conventional, several cases. We have Federal Housing Association, and the Veterans Administration or Association. I'll just say association. Go in and insure your mortgages so that the bank will give you a mortgage, because to a bank, if somebody's going to insure your mortgage, they have zero chance of loss. If it's a government agency that can be relied upon to honor this insurance, this guarantee. So these guys basically guarantee your mortgage and say, even if you don't pay on this mortgage, even if Crystal doesn't pay on her FHA mortgage, then the bank will not lose a penny on that because the FHA will pay the rest. Okay? Does that make sense? And mortgages that aren't insured are called conventional mortgages, by convention, I guess. Then we have fixed mortgages versus adjustable rate mortgages. So these are usually tied to either LIBOR or Treasury. By the way, the Treasury rates, when they're sort of referenced in popular media, they're called CMT, stands for Constant Maturity Treasury. So they'll tie your mortgage to the 30-year Treasury rate. Yeah. And so the way that these rates are quoted is usually, let's say, for instance, an example of a rate is, so, okay, LIBOR plus 3 means that your mortgage is going to be at the LIBOR rate plus 3%, 300 basis points on top of that. So if the LIBOR rate is, let's say, 0.47, then your mortgage rate equals 3.47. Does that make sense? So why would a borrower, well, let's think about this first. Who does this benefit? The borrower or the lender?
Depends if rates are going up or down.
What do you mean?
You're talking about if it's tied to the LIBOR, right?
Mm-hmm.
If rates increase, then it's good for the bank because they're gonna get higher returns.
Yep.
But if it's decreasing, then it's not good for them because people are getting dirt cheap, percentage rates on their loans.
Yep, that's a good point. So the net benefit depends on which way rates are going to move. But ahead of time, when you don't know which way rates are going to move, you have, let's say, equal probability of rates going one way or the other. Who does this arrangement benefit? The bank. Why is that? It all comes back to interest rate risk. The bank is exposed to interest rate risk. If interest rates increase, then if the bank had a fixed rate mortgage and interest rates increased, then the bank is going to be making less than it could be making. But with these arms, that's going to adjust upward. If interest rates decreased, what's going to happen? The borrower is going to refinance. So the bank's going to get screwed anyway. So whether or not the bank pays the borrower less when rates fall, or the borrower refinances and gets a loan cheaper elsewhere when rates fall, either way the bank's going to be screwed in the downward rate scenario. But at least with adjustable rate mortgages, the bank doesn't have to incur that interest rate risk in the upward rate scenario. Does that make sense? Okay. Why would the borrower agree to give this bank a benefit?
Their credit rating is probably low, so that's all they qualify for.
That's a very good point. So they otherwise wouldn't get credit. This is one way they can get credit. But for borrowers who have decent credit ratings and could otherwise get credit, then the reason they do that is because it gets them a better rate. So usually, I think the book gives an example where at some point, I don't know, fixed rate mortgages were like 3.25. This is the prime rate. This is the best rate you can get. But adjustable rate mortgages were like 1.49. So you get substantial discounts. This is the prime ARM rate. You know, if you have bad credit, you won't be getting this rate. But the way these are structured is your rate doesn't change every day that the interest rate changes, every day that LIBOR fluctuates. But in a period of 2 years or 3 years or 5 years, the loan reprices. And so at that point, the interest rate changes. And there's usually caps and floors that say that, sure, you incur the risk, borrower, of rates increasing, but we promise you that we won't increase your rates any more than 2 percentage points in any one repricing, for instance. Or if this is your third or fourth repricing, we promise that the rate won't exceed 6 or 7 percentage points of the initial rate we gave you. That's a example of a cap, interest rate cap. And so that's going to help alleviate some of the borrower's concerns about rates spiking up unmanageably. The bank will have to alleviate its own concerns as well by setting these interest rate floors. They say that, well, okay, we'll lower your rates, but we don't want to, we won't commit to lowering your rates less than 2% if rates go down. And so if rates go down 2.5%, a borrower is not going to refinance. It's not going to be that big of a difference, but the bank is still going to have, get a little more money. So that's how the bank protects itself a little bit. Okay. So we've gone over differences there. Oh, that clock's just not working.
7:15.
Okay, good to know. Thank you.
Gotcha.
You got my back.
Mm-hmm.
Moving on, we talked about basic kind of mortgages. Now we're going to get into a miscellany of different kinds of mortgages. So we have graduated payment mortgages. Okay? And these are mortgages where they're good for people just entering the workforce. So, for instance, when I started out, my salary was in the 40s, and in 3 years, my salary was in the 70s. So it's increased dramatically. So I couldn't qualify for a very good mortgage if my salary was going to be in the 40s permanently. And so employers to whom I could demonstrate that, hey, I have upward salary potential that's going to kick in very soon, can you give me this sort of like discount on the rates I'm paying now? Can you give me low, sort of low payments? Not rates, I should specify. It's not that that I have low interest rates now and high interest rates later. It's that I have low payments today and high payments later. And we're gonna go through an example real quick. Because if I were to have the same level of payment throughout the entire life, my debt to income would be in excess of the 33% ratio, right? So I wouldn't qualify for the loan. But in a few years, when my income spikes, then my debt to income ratio is gonna get a lot lower because the denominator is gonna get a lot bigger. You guys following me? Okay. How do you prove that? Well, you can show, so I had a career track, for instance, at the FDIC. So I could say, look, these promotions are step by step. All I have to do is not be a drunk, which is hard enough, but no. You know, it's sort of guaranteed. And likewise, if you have if you have documentation that, hey, you know, I got this new client, we're working out a business deal, these are all the reasons that deal's gonna go through, he just lost his last supplier, you know, it'll just take me a year to work out. They'll say, yeah, that's fine, you can make lower monthly interest payments for your first year, and then next year you'll have higher payments. So this is graduated payment mortgages. And this can actually sometimes even increase your principal. For instance, remember we went over the amortization table last class, and it was beginning balance, I'm going to abbreviate here, payment, interest, principal, and ending balance. Say we started with $100,000, and let's say our first couple payments were since we're dealing in thousands here, started with 100,000 and our first few payments were 5,000, okay? And let's say this is payment 1, 2, 3, 15, 360, okay? So for all these, we're gonna have $5 payments or $5,000 payments. And at time 12, we have this new payment scheme that kicks in, and we're gonna be paying 8, okay? And we're going to be paying 8 all the way to this 360. So what if the interest payments, as you guys remember, the interest payments are frequently, you know, sometimes 80 to 90% of the total payment in these amortization tables. So it's conceivable that interest payments would be, let's say, 7 here. The proportion that should go to interest is 7. Well, if I'm only paying 5, and 7 goes to interest, nothing goes to principal. And my ending balance is now 102. Because I didn't even cover their interest payments, their required interest payments. So what they did is they tacked on that difference on the ending balance. So now, on the second period, I have to make payments on a higher ending balance. So this is how you can increase your principal. And some people will consciously do that, knowing that they're going to be making so much money in the future. Let's say you're about to get promoted to CEO, you just need this other guy to retire, he's going to retire in 2 years, you've been working in the same company for 15. You're probably going to get that promotion, but you just have to wait for him to retire so you can buy a bigger house than you could otherwise afford. Another example of one of these schemes. So does this make sense to you guys? Okay. This is closely related to, but different from, growing equity mortgages. growing equity mortgages you can think of as just a pre-committed system of prepayments. Let's say I get a 30-year mortgage, and we have that same amortization table that I was supposed to make payments of 8 all the way through, instead of payments of 5 for the first few years and 8 later. I was supposed to make payments of 8 all the way through. But what I actually do is I pay 9 the first year, and 9 the first month, and 10 the second month, and 9 the third month, etc., etc. Then what will happen, once I cover the 7 interest payments, the rest will just go to principal. And so this reduces my principal balance much quicker. So that instead of taking 30 years to pay off this mortgage, it'll take me close to 17, let's say. Okay? So in both cases, you have payments that are sort of increasing as you go along. In the case of graduated payment mortgages, you start low so that you can afford something bigger. In the second case, in these growing equity mortgages, you increase your payments so that you can pay off faster. So this is for faster payment. And this is for sort of afford bigger. Okay, that's the principal difference between these two. But in both cases, you start with lower payments and the payments increase as you go. So now we have what are called second mortgages. Okay? And these were primarily implemented in the financial crisis to circumvent loan-to-value requirements. Okay? The company says that they can't give you, it's company policy that they can't give you a loan that is in excess of 80% of the asset's value. So if the asset is worth $100,000, their max loan equals $80,000. Okay? But what if you can't really afford this house? What you'll do, and you can't even afford $20,000 down payment on it. What you'll do is you'll get a mortgage for $70,000. So first mortgage for $70,000. And you'll get a second mortgage for $20,000. And so, in this case, the LTV equals 20%. In that case, LTV equals 70%. Neither of these ratios exceed the bank's 80% requirement. If you look at both of them together, and if you're a careful credit analyst, then you will see that, hey, this guy's not going to be able to make payments on this. But the way the requirements were written was just, thou shalt not exceed 80%. And so they managed to circumvent that requirement. And these are called second mortgages or piggyback mortgages.
Is that 80% rule like pretty universal?
80% is a really good rule of thumb. Your average risk is definitely going to vary individual to individual, let alone institution to institution. That's the risk tolerance. But 80% is the best rule of thumb. Some will say 75%. In my experience, it's 80. Okay. What's safer, 75 or 80, guys?
For whom?
For the bank. 75. Okay. Put you on the spot. But because there's more down payment, right? The down payment is the difference between the 75 and the 80, right? Or between the 75 and the 100, or the 80 and the 100. So if there's more down payment, the person will be willing to absorb further losses before he walks away from the mortgage. Make sense? Okay. And finally, we're going to get into, not really get into, but I'll mention reverse mortgages. Okay? Has anyone seen the movie St. Vincent? Started to watch it last night. But at the beginning of the movie, Bill Murray goes to a banker, and the banker says, look man, we can't pay you any more money, we paid you all the money, right? And the way he's getting this money is, let's say you've spent most of your life paying down the house that you bought, right? And so we did this amortization table. You had a 360 period loan, 360 month loan, so 30-year loan, and we're in period 240, so we've gone 20 of those 30 years, and you basically owe, let's say another, I don't know how much, you own, let's say 80% of your house, right? So you started by owning 20% of your house and the bank owned 80, and now after 20 years of diligent payment, you own 20% of your house. There's a problem. You're 70 years old and don't plan on living much longer. So why should you keep making payments on this house and then just die? What you do instead is get a reverse mortgage. And you say, you know what? Not only am I going to stop making payments on this house, but I'm going to have this house make payments to me. And you slowly relinquish this 20% ownership. The bank gives you money every month, and let's say after a year you now own, I'm sorry. Take a step back. At the beginning of the example, you owed 20% of your house, so you owned 80%. Okay? So as the bank makes payments to you, you owe more and more, right? So after a year, let's say you're up to 22. After 2 years, let's say you're up to 26. After 3 years, you're up to 30. After 4 years, well, you die. And so what happens is now the bank can, or your estate can sell this house and pay the bank back. And you still not a lot of risk to the bank, because at the end of the day, you only owed 30%. What happened in that movie, St. Vincent, was that once it gets back up to 80, the bank can't make your payments anymore because you're at their LTV. So then you have to start paying back the bank. It's a vicious circle. But this is basically a way for old people to finance better lives than their retirement planning can afford. Does that make sense? And so a lot of people got screwed, like Bill Murray did, by outliving their mortgage. So they can no longer get money from the bank by selling their equity back to the bank, so now they have no source of income. Okay. So these are different funky lending products. Skip loan servicing. Okay. So, real quick, when a bank makes a loan, it basically has 3 options. I said we'll skip loan servicing, but we won't. Bank has 3 options. It can hold the loan. It can sell loan and service it. And it can sell loan and the servicing rights. Okay? If you service the loan, you get sort of a premium. So this is why banks want to do that, but I won't get too far into that. But once these banks sell the loans, whichever one it is, an agency, originally Fannie Mae, and then Freddie Mac, and Ginnie Mae, buy these loans, and they put them in a pool, all these different loans that they bought, they put in a pool, and they make a security out of it. Okay? The security is a CMO. Well, it can make one of 2 securities. Let me write this properly here. Okay? They turn this pool of mortgages into mortgage-backed securities. So I'm not gonna write it on the board, but MBS means mortgage-backed securities. These are different names of agencies. You can read the book for further detail. But mortgage-backed securities can be subdivided into pass-throughs and CMOs. Okay? Pass-through securities are simple. Pass-through securities are called pass-throughs because as each of these loans makes interest payments and principal payments, that money gets passed through to the ultimate investor. That is, there is only one type of investor in mortgage-backed securities. All investors are created equal in pass-through mortgage-backed securities. Okay? This is in contrast to CMOs. So CMOs are much more interesting. In CMOs, we have tranches. Okay? We have sequential. Okay? Sequential payment tranche is relatively safe. All this is saying is that you have investors that line up here and rank 1, 2, 3. So 3 types of the sequential payment tranche investors. So as the money comes in, the principal, bless you, the principal is used to pay down, bless you, tranche 1 of the subset, the first subset of sequential payment investors, okay? So they get principal payments first. The second group gets principal payments second and third. Okay? So this is really convenient for investors who have different investment horizons. Let's say we know that the average life of a mortgage is 8 years. The average life of a 30-year mortgage is 8 years. To understand the security, you really have to understand how the mortgages in your pool differ from.
What do you mean by 8 year?
That means, on average, when you consider prepayments and you consider refinances, it takes a person 8 years to pay off a 30-year mortgage. Because some people will refinance in 3 years, most people will make above the minimum payment. I shouldn't say that. I don't know. You might want to make above the minimum payment, but it takes an average of 8 years to pay off a 30-year mortgage. Okay? So if that average was set in stone and everyone understood it very well, then you get this first tranche of people who wanted to receive all their funds within 3 years, this second group that wanted to receive all their funds in around 5 years, and they would get all their money returned to them by that time, and then you had this third group that would get everything around year 7 and 8, if that was set in stone. The problem is there's prepayment risk. You don't know whether people are going to prepay or not. So it could be that it takes these guys 10 years to get their principal back. If nobody prepays, they were planning on getting their money back in 2 years, it'll take them 10 years. These guys, it'll take 10 to 20 years to get their money back. These guys will take 20 to 30 years to get their money back. So you have to be very careful, there's risk involved. But, that being said, these are still the safest tranche. Gets worse. But so far, do you guys understand how the sequential tranche works? This is heavy stuff that I'm explaining to you guys, by the way. You probably won't get this in other financial markets and intermediaries class, but it's interesting stuff. Okay.
There's a timetable for the 1, 2, and 3. Those are investors.
Yes, 1, 2, or 3 are investors. So
They
this
each
class
have-
of investors gets the first group, they'll call it this is abbreviated as SEQ. So what you'll note is, Mario, you've looked at Bloomberg, right?
Yeah,
Have you looked at any sort of mortgage-backed securities in there?
no, not yet.
So any security, any debt security has what's called a QSIP. I don't know what it stands for, but these QSIPs will be a string of letters and numbers, and they will end in 3 numbers, let's say or 3 letters or numbers, FV5, okay? So this security is called FV5. And then, on top of that, we'll say FV5 sec to denote that it's the sequential tranche of the security. And after that, it'll say sec A to denote that it's the first group of the sequential tranche of this FV5 mortgage-backed security. It's pretty complicated stuff, but we won't get bogged down in that. But there's all these numbers and letters have meaning. But anyway, so each of these have a different investment horizon. That's why they're investing these, right? And naturally, the ones who have the longer investment horizon are going to demand higher compensation. So these will probably yield more. The interest payments promised to these guys is more. Now, the more risky tranche is called the PAC, Planned Amortization. I'm sorry, this is the less risky tranche. So planned amort. This is going to be the more risky tranche. So instead of incurring this prepayment risk, these guys, this is called PAC. These guys plan their amortization schedules. That is, the issuer of the security says that, okay, we'll call it A, B, and C. That the A class of the PAC tranche is going to get their principal returned in 3 years. Okay, here it's going to be 6 years, and here it's going to be 10 years, for instance. Okay? How are they able to promise these guys a finite return of principal if the actual payments that come in on the mortgages are variable? They do so by exploiting another class called the support class. Support tranche. So basically what happens is if there is extra prepayment, more prepayment than we anticipated, what Ginnie Mae will do is they will give that extra money to the support class. Here, you guys have more principal, bless you. Okay? If there is not enough money, they promise the support class an interest rate of 10%, let's say. They're going to take away some of their interest. They're going to say, sorry guys, we can't pay you this 10% interest rate. Turns out you're only getting 2% this quarter. By the way, these make payments quarterly, unlike other bond securities that make payments semi-annually. But these guys support the promises for the PAC, okay? So if they promise principal return in 3 years, there's a schedule that every year, every 3 months, you'll be getting $4,000 back, for instance, okay? And actual payments that come in on these loans are a lot more or less. But they are able to consistently give these guys, what did I say, $4,000 a month? Yeah, they are able to consistently give these guys $4,000. These guys, because they want their principal back in 6 years, they'll say, we're going to give you $1,000. These guys, they want their principal back in 10 years, they'll say, we'll give you $500. But whatever they're giving them, the interest rate is always going to be higher for this longer term class of the PAC tranche, as it was for the sequential tranche. Okay. How are we doing on this so far? Really? Okay, fair enough. Okay.
Just being honest.
No, I appreciate that. That's way more helpful. Okay, how are we doing on time? 13 minutes. Try to cheat me out of 3 minutes. Okay, let's try again. So, did we get mortgage-backed security pass-throughs? Where as the money comes in here, this agency passes the money right through the investor. There's only one type of investor. Okay? Did we get mortgage-backed security, CMO, sequential payment tranche? That's where I'll start. Okay, so
And CMO was what?
collateralized mortgage obligation.
Okay.
And these are, so the.
Mortgage-backed securities, pass-throughs, and collateral, you know what I mean.
Is this,
Yes. mortgage-backed security, pass-throughs, and, so there's two types of mortgage-backed securities, pass-throughs and CMOs.
Is a CMO a CDO?
No, it's not. There's a distinction. CMOs are the M here. What's the D in CDO?
Yeah.
Debt. So this implies that there's some kind of collateral. For debt, there's no collateral.
They're collateralized?
They're not collateralized. CDOs are not collateralized. Shoot. Yes, I see what you mean. So they're collateralized by like business assets. There's no mortgages on there.
Okay, so this is just mortgages,
Yes.
but CDOs can be.
Yes, collateralized.
Debt obligation.
I don't think they're super collateralized. I don't think they're collateralized. I think they're just, I'm pretty sure, I'm gonna double check. Somebody who has a computer might wanna double check, but anyway, I'll double check. That's a good point. But, there's still holes anyway. Back to CMOs. Taylor.
So it seems like sequential and planned amortization are similar in the fact that, you know, one through, they kind of go in order.
Mm-hmm.
So what's the biggest difference between the two, if they each
Okay.
have their order?
You can think of this as combined equals that. Great question, Taylor.
Okay.
So here, these payments, the amount you're actually going to get as a tranche 2 investor is going to vary based on the amount of actual payments that come into this pool of underlying loans. Jackson?
Do you get put in these tranches, or do you know, like?
You sign up for these tranches.
that
You
I'll
say,
buy bond at the end of this tranche?
Yes,
And
exactly.
you buy them from Fannie Mae?
yes. There are private label CMOs, which are much more risky, because at least these are guaranteed by the government.
Wait, so which one would you want to be in? Like-
Depends on your risk tolerance. So
Okay.
these have much higher yields. So if you can afford to lose a lot and you're trying to make a lot of money, like us young people in this room, then we can afford more risk. If you're close to retirement, if you're gonna have to do a CMO, which probably is ill-advised, you definitely wanna be doing this pack here. This is sort of the safest, because you know how much you're getting. So to reiterate Taylor's question, the difference between the sequential payment tranche and the planned amortization tranche is that you can think of this as just a regular bond where you get fixed interest payments. Okay? The way they're able to supply you with fixed interest payments here is by using these guys as a cushion, this support class. So if we get more payments than anticipated, because we're going to anticipate a weighted average life here, we're going to anticipate that it takes 8 years, we're going to plan our entire security around that 8-year guess. If we get more prepayments, so that weighted average life goes down to maybe 5 years or 6 years, we get more money coming in today, then what we're going to do is feed the extra money to these guys, but meanwhile make your promised payments here. All the while, we're promising these guys a rate of return. We're promising these guys that they'll make 10 or 15% return on their investment. Every year they'll make 15% interest, okay? But what happens when the opposite scenario occurs? So it's not that the prepayment is increasing, it's not that prepayment is going faster than we anticipated, it's that prepayment is going slower than we anticipated. We thought that everyone was going to refinance, but turns out rates went up and nobody refinanced. So these guys aren't going to get their 15% return. They might get 3 or 4% return. The rest of the money that we promised them is going to go to this PAC class.
They're
Okay?
just the excess group.
Yes.
Or if you have excess, it'll go to them. If not, they're just.
Yes. These are they're also called the companion tranche, but they're used to basically absorb the excess. Okay?
And that's just an extra box at the bottom.
No, we'll get there.
Okay.
So let's see. Get that. And that's in contrast to the sequential payment tranche, which it's safer than just being here, but it's still variable. You don't know exactly when you're going to get your money back. Okay? These guys know when they're going to get their money back. The most risky class here is called the Z class, Z tranche. Named after Dr. Wilhelm Z. No. This is the last people to get money. Because the way this works is like a discount bond. You can think of it as these guys pay money today to support this CMO. Let's say that is a Z. That is very confusing with a Z, but a Z nonetheless. So, there's an E at the end of tranche. Tranche is French for slice. So, basically, Ginnie Mae promises to return to you $1,000 for every $300 that you put in. They don't tell you when you're gonna see the money. They can't necessarily guarantee that you see the money. The only thing that's guaranteed in these mortgages is that the collateral won't lose value. So the principal will be repaid. These guys' payments are all interest. So if everything goes well, then you'll be making all the interest you expected to make over the 8 years, and these guys will get their money. In contrast, if there's a lot of prepayment, then for those last 2 years, you're not going to be receiving any money. You gave all that money away already. So this Z tranche makes nothing. So 2 things I want you guys to remember about the C tranche is that it's like a discount bond in that you pay money today for the promise of receiving money in the future. Whenever the security totally pays off, you don't know exactly how much money you're going to get. You're given a promise and an estimate, and they convince you. So there's that. It's like a discount bond, and it's the riskiest. It's the riskiest of these classes. Okay. The other thing I want to say about these tranches is that they can be either fixed or floating rate. So the way each of these works is, with any amortization schedule, you're promised principal and interest, right? That interest rate that you're given can be tied to something, so they can be floating rate as well. But I don't expect you guys to perfect your understanding of this stuff, but do you have a baseline understanding about the complexities of a CMO, at least? I would like you to try to remember that there's different tranches, and potentially relative to another tranche, what the advantage of one would be or disadvantage. But you certainly, most people in the financial
Time's
sector. No, it's not.
No?
No.
We don't go to 7:45?
No, we go to 7:50. Read your syllabus before you correct me, man. But let's see. Okay. CDOs. Let's see. I don't like the book's definition of CDOs. Time's up. I don't want to go into another topic here. So this will be all we'll learn about.
Where's the, on the Z tranche?
No, there's nothing in the book about CMOs. I can send you guys a resource about CMOs if you'd like. Sorry, Sam. I wish that book had stuff. They just.
It says a little bit about CMO.
Yeah, it doesn't go into the detail.
So look it up in detail.
Yeah. If you'd like, I'd be happy to send you a resource, or if you want, you can explore it.